Hey YouTube, welcome back to my financial focus. In this video, I wanted to talk about put debit spreads, and just to break down how this video is going to go, I'm going to talk about how to open up a put debit spread on Robinhood, and I'm going to talk about how one makes money and how they lose all their money in this particular trade, like what the max profit is, the max loss, and how that would happen. And then I'm going to talk about the advantage of put debit spreads over just like buying a put contract. So let's just get right into this and not waste anyone's time. The example ETF I'm using for this is SPY, which is the S&P 500 ETF. And how this would work is you just click on trade options right there, and then this options trading calendar would pull up. And how someone opens up a put debit spread is they're going to buy one put contract and they're going to sell a put contract at a strike price that is lower. So you buy the put contract that is at a $441 strike price, and then you sell the put contract that is at a $440 strike price, so the one that's lower than the one that someone buys. And basically you can see right here that the total cost of this would be 34 cents or $34 since we're dealing with 100 shares. We'll see multiply this by 100. And you can see the max profit down here, which is $67. So basically this is like a 100% return. Max loss, $33. Max gain, $67. So typically how much somebody spends is going to be their max loss. So if we click continue here, this right here shows like the range of how much this spread is going for on the market. So it's going for a high point of 34 cents and a low point of 31 cents. And so the max cost just on average is $33. So the max loss would be $33. Max profit would be $67. And you can see that this is pretty lucrative because this is a 100% return in just one trade. And if this is expiring September 20th and the share price hypothetically was like 439 or 438 or even 440, if it's like right on the dot of 440, and the max profit would be gained, and that's by September 20th, so that's just in like 3 days. So over a 100% return in 3 days. It's pretty good. And basically, now I'm going to talk about how someone would make money and lose money in this particular case. So the way someone makes money opening a put debit spread is since it's a bearish strategy, meaning you want the share price to go down in value, as long as the share price is below the strike price of the put contract that we sold, which is $440 in this case, then the max profit would be realized. So as long as it's $440 and below by September 20th expiration date, then the max profit of $67 would be made. Now, the way somebody loses money opening a put debit spread is if the share price were to go up. So the for every penny that the share price rises above $440, $1 of profit would be knocked off of the max profit. So if this is $440.01, then the max profit would be $66. If this is 2 cents, it would be 65, 3 cents, 64, 4 cents, 63, and so on. And so if this is $440.67, then the total profit would be lost. And obviously as it gets even higher than that, it's not like as it gets higher and higher, like someone would just start going in negative. No, the max loss would be however much they spent on the contract. So as it gets like higher and higher in between these two strike prices, it starts to eat away at the max profit. And then once it gets to $440.67, for every penny that it goes above that, it starts eating into the cost, which is 33. 33 plus 67 is 100, which is the difference between these two strikes. So if it gets above $441, the share price that is, then the max profit and the total cost of entering the spread would be completely lost. So When opening up a put debit spread, somebody can break even at $440.67 because then they would have a max profit of 0, but they would still have their $33 dollar cost, right? And so if it goes above 441 like it is now, if on expiration date it ended at like 441.02, this would be a $0 gain pretty much. They would just lose everything. And if it was lower than 440, then max profit would be realized. So now I'm going to talk about the advantage of opening up a put debit spread over just buying like a regular put contract. So the advantage is in the Greeks. So there's something called theta decay, and theta decay is basically how much value a contract loses with each passing day. So basically this contract loses 33 cents with each passing day that we get closer to expiration date. And so 127 minus 33 is 94. So with, let's say like if this was like 127, like on the day of on one day, like after the market closes, when the market opens the next day, no matter where the share price goes, even if it stays exactly the same and just stays flat and doesn't go up, doesn't go down, just stays flat, this contract will lose 33 cents. And so the disadvantage with that is, let's say hypothetically somebody just bought this put contract. They need this SPY ETF to decrease in value quick enough to where the increase in value of the premiums for the contracts is more than the decrease in value from theta decay. So basically somebody would need this to increase by 34 cents a day in order to stay profitable. So because every day this loses 33 cents, so they would need to make at least 34 cents to be profitable, and at least 33 cents a day to break even. So this share price has to move down in order for them to even break even, and it has to move down even more in order for them to make money. Now the advantage with just buying a regular put contract is the max profit, which is pretty much just however much they would make if the share price dropped to 0. So if on expiration date SPY is at 0, they would make this much money. So the advantage that comes with put debit spreads, well, first I'll talk about the disadvantage. The disadvantage is that obviously the max profit is capped. They can't just make unlimited profit, or not unlimited, but make profit to 0. No matter like where the price is, as long as it's below 440, they will make 67. So if it's at 439 or 0, they're going to make $67 no matter what. But the advantage is that put debit spreads aren't beholden to theta decay, so they don't lose value with each passing day, which in my opinion is the biggest advantage of opening up a put debit spread. Since the put contract that we bought loses 33 cents and the put contract that we sold loses 33 cents, it cancels out, because remember, when we buy a put contract, the 33 cents, it decreases the premium, and so we lose money on that, right? But when we sell a put contract, we're collecting the premium, we're not paying for it. And so the 33 cents is money that we make. So we're making 33 cents on this contract, we're losing 33 cents on this contract, and so it cancels out. We're not losing anything, we're losing 0 cents. And so basically, if somebody opens up a put debit spread, they can continue to roll that spread over to the following week, the following week. Like if it's September 19th or September 20th, and the contract isn't profitable yet, they can just close it, and then whatever they get out of it, like whatever is left over, they can just open up another spread for a different expiration date and just keep on rolling it over until the share price drops and they make money. So that's the advantage that I see with put debit spreads. And I'm actually currently holding a put debit spread for Alibaba, because Alibaba is a Chinese stock, and Chinese stocks have been plummeting recently because of government regulation. So I'm bearish on Alibaba. And this is just an example of opening how to use a put debit spread in the market. Just find a stock that you're bearish on, that you think is going to go down in the short term or the long term. I think long term Alibaba is going to go up, but like 5-10 years. But short term, I think they're going to keep going down. And so I opened up this put debit spread, and that's basically how put debit spreads work. So yeah, if you guys found any value out of this video, be sure to leave a like, comment down below what options trading strategies you guys are using. Subscribe to the channel if you haven't already. It would really help me out, and I'll see you guys in the next video.